Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, traders and investors. Welcome to this Tuesday edition of Benzinga's Pre-Market Prep. I'm Spencer Israel, here with Joel Elconin and Dennis Dick. On the show today, two guests for you. Phil Bach, CEO of ACSI Funds, will join us at 8:15. JC Parets, author of AllStarCharts, will join us at 8:35. But before we get to those guests, we got to talk about the biggest stories of the day. That is, we got some someone sniffing around in potentially SeaWorld. We've got some Amazon news that's hitting FedEx and UPS. And we'll talk about the biggest movers from yesterday. We'll take your questions in the chat as always. Joel, what's doing in the market?
Take a guess. The S&Ps are trading higher by $1.25. Easy numbers for you. 38 even. That was yesterday's high. That's the all-time high. 2 ticks away from that. So that looks to go by the wayside. Crude hanging out just under $50, down a couple pennies at 49.98. Gold getting a little bit of a lift up 280 at 1279.60, and silver 1665 up 4 cents. So not a lot of movement in the commodities, but we got a lot of stocks moving this morning. Dennis, where would you like to start?
Always stocks moving, individual stocks, and it looks like Amazon, the disruptor, disrupting shipping, which is not shocking to me. I mean, here, okay, we got UPS and FedEx trading down. Spencer, give us the news here, and then we'll give you the analysis.
Sure, and I would like to see a breakdown of how exactly, how much business FedEx and UPS get as a result of Amazon, because they said they're testing out a new delivery service that we're going to make more products available for free 2-day delivery. As of now, most of their products are not available for that, which is why Amazon is so reliant on UPS and FedEx. So if they were to make more products available for free 2-day delivery, it would cut UPS and FedEx out of the loop for more shipping, and it would just cut down on warehouse overcrowding as well. So they said that this could be rolled out, or is expected to be rolled out in 2018. Don't know when, next year, but sometime next year. So it's just going to reduce their overall reliance on FedEx and UPS.
Okay, so here's Amazon that basically has all of their products shipped. You're telling me eventually they're not going to ship all the products themselves? I mean, if you think they're coming in and disrupting the food industry and they're disrupting, every other industry out there, that's like low-hanging fruit, is to, eventually ship all their products themselves. So, I don't find this surprising at all. And this is the main reason. And I'll tell you, I was way too early on this one. I owned FedEx in my portfolio for a long time. The main reason I sold FedEx out of my portfolio was because eventually Amazon, I figured, was going to ship all the products, and that was going to hurt FedEx. And if we're going to buy, everything off of Amazon there, if Amazon's eventually got drones and shipping all the stuff themselves, they're not going to need FedEx, and that's not good for the stock. I sold my FedEx stock way back at like $170, and I was obviously way too early because it ran to 221, now 225. I'm still holding that thesis that I'm not buying FedEx and UPS in my portfolio because I do think eventually Amazon ships all their products themselves. So, they're obviously going to get still a lot of business. People buy stuff online from other sites as well. And FedEx and UPS are still going to be feeding those sites. So you can make the argument that way. But if you're really a believer that Amazon is taking over everything, and they're taking over everything that's going to be bought online, or the majority of sales online, I think it's hard to own FedEx and UPS. So that's, my story on it, my theory on it. Your thoughts here, Joel, as FedEx and UPS trade down about 3% on this news.
This is not new, though. We've heard.
It's not.
No,
that's why I've already been scared about this before. That's why I sold the stock a year ago at like $170. And when I sold it, it was up near all-time highs. And I was like, you know what? I bought it at 90. It ran to 170. Valuation wasn't nearly as attractive anymore. And the story was that Amazon was coming, to eventually ship all their products. They were in drones. Eventually, Amazon's going to ship all their own stuff. So I didn't figure that was good news for FedEx and UPS. Wow, now here we are. It's been running. And now we get, another headline about this, and the stocks are down 3%, or 2%. I don't know. I think this is just obvious.
It is, and you know, the price action, we can talk about it from a long-term perspective and a short-term perspective. I'm just going to hone in on, you know, the pre-market trading here. If you're worried, like Dennis was, I mean, you're still up near all-time high, so you can ring the register. That's not going to say these stocks are not going to, you know, shrug this off. And we've seen what happened to Kroger and some of these other stocks when Amazon comes into the space. So the pre-market low in UPS is 114.50, but we got a $2 bounce off that. So I'll use that as a level. Going on the daily chart, you haven't been under 115 in quite some time. 114, I see a double bottom at 114. So if you take out that pre-market low, I see some support at 115. Coming back on the upside, I'm sure a lot of people would like to see this fill the gap from yesterday's low at 1868. That's a little over a buck away. FedEx, same story. Got hit, bounced back. I got FDC up there. Let me go with FDX. Pre-market low is 215 in FDX, getting a little bit of a bounce here at 217. So they're off their lows for the session, Dennis. Let me give you a level here. Do we have anything? 215 matches your September 19th low. So both areas of support. I just think if they're breached, look out below.
I'm really torn on this because this is something, I don't feel like this is new news. So, from that perspective, I think, they should bounce back because everybody knows eventually Amazon's going to probably be doing most of the, not using FedEx and UPS for a lot of the shipping. But that being said, that was the whole reason I sold FedEx before. So Frankie's saying good idea, or good eye, Dennis. But I sold way too early. I was way too far ahead of this because I was selling a year ago at 170 because of this, and then ran another 50 points. So I may be right, but I was way too early on it. So and I left a lot of money on the table because of that. So I'm not coming here buying FedEx and UPS because I still think it's the same story. I mean, I'm torn on these two stocks too because it's a valuation issue for a little bit for me with FedEx and UPS. They've run up a lot. I mean, when you look at the FedEx chart over the course of the last 5 years, it's run, well, I guess, considering what the market's done, I guess it's kind of performed with the market because we were about $100 5 years ago. Now we're 221. The S&Ps, if we go out to where they were 5 years ago, they were about 130, 250. It's a little bit outperformed the market. And UPS has actually underperformed the market massively, really, when you think about it, because it was at $80 at 119. So it's only up 50% of the time that the market's up about 70. So if I had to pull the trigger on one and you wanted me to be in one, I think I'd pick UPS, but I think I want more of a pullback here. Valuation still is not that attractive that I got to be jumping into something that Amazon might be attacking.
And I just think Spencer made a great point, and maybe Benzinga can get an article out on it later today. What actual percentage of business does FedEx and UPS get from Amazon?
I'd like to know that too.
If it's 15%, I mean, if it's a large number of their business, then hey, you gotta crunch the numbers. But that was a great point brought up by Spencer.
Let's jump over here to your only earnings stock of the day, and that is Constellation Brands, ST, a zebra here, trading up 9 points. I guess people are still drinking their Jack there, Spencer. Talk to me. What were the numbers for Jack?
Well,
and we're talking STZ, so don't get confused with Jack in the Box.
I was. People are drinking, whether it's an up market, whether it's down market, doesn't matter. People are drinking. So
this is like your stock that just works because when the market crashes, people really go out and get the Jack Daniels. Right.
Never out of favor. Q2 EPS $2.58. That may not compare to the $2.17 estimate. Sales of $2.085 billion versus $2.06. So slight miss, but just about flat on the sales. They're also raising their outlook for the fiscal year 2018. They're raising their adjusted EPS. It was $7.90 to $8.10. Now it's $8.25 to $8.40. So they're raising their EPS guidance for the fiscal year by 35 cents on the downside.
Well, I mean, this is all-time highs, correct, Joel?
Far and away all-time high, Dennis. We hit 210.85, your former all-time high. Now is going to be support. That's 204.47. So those are really the only numbers I could give you. 210, it's holding right now. I don't know if it's bid or offered there. Under 210, a lot on the downside. Pre-market high, 210.85.
I'm looking at the book. That book is empty. I mean, empty. Now it's early yet, and it's a $200 stock, but there is hardly nothing in the books. So I don't think anything from an order flow perspective is going to hold this back. When stocks are making new all-time highs, if I'm short them, I don't want to be short them. One thing, I don't like to be long stocks making new all-time lows, and I don't like to be short stocks making new all-time highs. This one's moving up here. So I'm a buyer of pullbacks on Constellation Brands, the stock that works in any market, as Spencer says.
S&P's bust through 38 even, just made a print at 38.75, so just got a new all-time high in the pre-market session, 2538.75, and Constellation Brands moving lockstep. Just another print here at 211.33. As Dennis said, there's nothing in the book holding this down off the open.
Yeah, I know it popped as soon as I said that. I'm a disruptor and a mover here now. Andrew left. You got nothing on me. Let's speak about Andrew left, because holy cow, his influence is absolutely amazing. Love him or hate him, say what you want, that he's buying or shorting these stocks, he's shorting these stocks and tweeting out negative reports on them and really talking his buck. But man, his influence is absolutely incredible. The last one he took down was Veritone, VERI. Stock was up at its all-time highs around $74, and then the epic collapse. Something that's been noticed the last couple times, though. So yesterday was Shop. Yesterday, he came out with a negative tweet on SHOP, and that knocked the stock down significantly during the regular session there. But one thing you noticed, Joel, one thing I noticed as well, and I think Ace was pointing this out too, is the fact that these stocks start falling before the tweets. And if you look, and let's just go grab the timestamp on the tweet. Spencer, can you go to Citron's Twitter account? Look at what time that tweet came out. And look at what time SHOP actually started falling, because it fell for about 10 minutes before that tweet came out. So obviously, unless he's posting this somewhere else before Twitter, and maybe that's a case, there's a few people that know he's going to tweet this.
The exact time yesterday.
What time was the tweet?
It was 9:49 a.m.
9:49. The stock opened down. So it opened down on no news yesterday, opened down. And by 9:49, the stock was already down $5, $5, $6, $7 even. So it was already down significantly here. Joe, can you go right?
Yeah, I got it, Dennis. I'm right here.
Give it to me.
I am right here on it right now. It had hit 119.50 in the pre-market. It was trading at the $111 area when that tweet came out. And all this price action here from 117 to 109, all that slamming, that was all pre-tweet, at least 10 minutes before the tweet.
Yeah. So what's happening, I think, and unless maybe it's posted somewhere else before he tweets it out, but I always thought it was the tweet. He was tweeting it before, because he said, what did the tweet say? Spencer, what did the Citron tweet say?
Says that Shop is a business dirtier than HLF. If the company is 2,500 plus merchants and $25,000 advanced, who are the other 470,000 merchants at FTC? He had to tag the FTC.
And that was the first tweet. That was the only tweet.
No, second tweet. Full story up in 1 hour. Video live now. Shop is not the company.
Okay, so the story wasn't even up yet. So he just tweeted out that the story is going to be coming live, and that's when it gets hit. But it got hit, you were saying, 19 minutes before that. So who's getting the memo that he's going to tweet this out? All of his employees, or is it all of his friends and buddies? I mean, it's a hard thing. This isn't insider information, though. It's an opinion. So he's got fair reign on this. I mean, either the SEC tightens up restrictions, or I think he's in the clear. I mean, he's just giving an opinion, Joel. It's just that his opinion is more influential than anybody else's opinion. I mean, everybody's entitled to their opinion. Everybody's entitled to talk their book. We've talked about Icon doing it for years, but when Icon talks about something, it goes up 2-3%. It doesn't fall like Veritone 30%. I mean, this guy has more influence than anybody. So props to him. Love him or hate him. Props to him for building himself up that much that he, I'm going to say it again, is the most influential person on the street right now. Because I don't know if anybody just tweeting about something can knock, Shopify down $15 just from a tweet. That's incredible.
Real quick, I know we got a break coming up here, but I mean, he picks on stocks that don't have the great amount of volume either. I mean, Shopify.
And that's intentional.
Yeah,
for sure.
Yep.
You're not going to come out and say this on JP Morgan, because how much is he going to move JP Morgan? It's thick. He's picking on thin stocks, and that's part of the strategy too. I mean, it's a license to print money, really, but it's legal as far as that's what's my opinion, but I think he's legal on this.
10055. That's your pre-market low. Your low from yesterday, 10075. I know John Dotson's looking for a little breach of that 100 today. I will tell you, if you get under 100, keep an eye on the $97 level. Two lows at 96.62 and 97.14. But Spencer, we got a break coming up, right?
Yep, Phil Bach is a local Michigan guy, CEO of ACSI Funds, going to get his thoughts on the market from an ETF point of view. So we'll be right back with Phil. Joel Elconin and Dennis Dick. We're on the line with Phil Bach. He is the CEO of ACSI Funds. Phil, how's it going today?
Good. How are you?
Doing well. So, Phil, we are just now at the outset of final quarter of the year. Any stocks that you're looking, that you have your eye on, that you think are maybe in a good position with maybe some recent data or stocks that are well positioned for Q4?
Yeah, I mean, what we're seeing right now is consumer sentiment, consumer confidence, consumer comfort, and our measure, the broad ACSI index, which measures customer satisfaction, are all at or near their 15-year highs. So we're seeing really, really strong consumer data. So even though, the capes are high and PEs are high and the market is pretty well priced and we're coming off this huge bull run, we think there's going to still be a lot of consumer spending going on for the rest of the year. We think we're going to have a very strong holiday season at the end of this year. And, the question is where you want to bet on that. Last year, Amazon did over 30% of all online holiday shopping, which is just an incredible number. We think that's even going to grow this year. We're very bullish on Amazon. But a lot of people are, heavy into the FANG trade already. And, if people want to take some money off the FANG trade and start looking further downstream for companies that might benefit, one that we like a lot is eBay, actually, which is up this year 30% more than Amazon or Google. But we see really strong sentiment around eBay, really strong customer satisfaction, and we think there's room to grow.
So you were on our show back in March. Explain again sort of what the ACSI index does.
ACSI measures customer satisfaction, and the thesis is that companies whose customers are satisfied with the good or service they're receiving are going to do better over the long run than their competitors. And we've got 20 years of academic data that backs this up. We've had a hedge fund managed for about 10 years, and last November we launched an ETF, which is a long-only rules-based quantitative index ETF that that selects and weights stocks by their customer satisfaction rating. And the idea is that we can use it as a leading indicator. So if sentiment is moving away, let's say from Toyota to Ford, the guy who's looking at the traditional value metrics has to wait for those transactions to occur, has to wait for those people to go in to buy their car, for it to hit the financial statement, maybe for the company to even announce a dividend before it hits his model. Whereas we can get out in front of those trends and use the data as a leading indicator to select stocks.
All right, so we've got eBay with some positive sentiment right now. Any others that you're seeing right now that have good or positive or rising consumer satisfaction?
Vonage has been terrific in the telecom space. Vonage is up 31% over the last 3 months, but it's not overbought. There's still, again, more room to grow here. We think Vonage is very, very well positioned to continue to take market share and to continue to grow.
What about other areas of the market? So, the ACSI index, of course, obviously covers a lot of retail. Are there other areas of the market that you watch?
Yeah, we do. We look at things from a macro perspective, and obviously there's a lot going on right now that is, pretty interesting. I mean, there's always, it's like we didn't start the fire, but we're watching EWP, which is the Spain ETF for my shares, and trading off of course, geopolitical risk, which is not necessarily our area of expertise, but there are some opportunities there to make some trades that I think, if you can get the macro directionally correct, then there's some big opportunities there. I mean, overall, we're seeing volatility is very low. Another thing that we track, which we think is interesting, is correlation within asset classes. Right now, if you look at the SIBO S&P 500 implied correlation index, it's quite low, and the Russell 3000 has a lower correlation between the stocks within the Russell 3000 than they've had in 15 years. So there's a lot of talk out there about how the migration towards passive cap-weighted ETFs is somehow hurting price discovery and making it harder for people to find active stocks or trades that they can make money on. We're actually seeing the opposite. We're seeing that there's a lot of opportunity now for stock pickers and for people to make trades because of the declining correlations within asset classes. So there's a lot of interesting things going on right now in the market. There's a lot of opportunity. It is an expensive market, but the market could stay irrational a lot longer than you could stay solvent. And with consumer spending continuing to remain high, we think that these valuations can persist for quite a bit longer.
We were talking on our show yesterday and the day before about airlines, and you brought that up before when we called you. What exactly are you seeing there?
Airlines have been beaten up pretty badly earlier this year, but the demand for airline usage is not just going to go away. Now, there's a lot of sensitivity to oil prices. That's going to continue. So there's a bit of an oil trade, or you can hedge it. You can hedge your oil exposure with the trade. But again, here's another area where we're going to see some separation between the wheat and the chaff. So, traditionally, when people bought airline tickets, most consumers would go on Kayak or wherever they go to buy their airline tickets, and they would pick the cheapest flight regardless of the name of the carrier. And what we're starting to see, the turning point here was the United incident where they beat up the doctor. He got bumped from the plane. And what we're really starting to see now is that people are willing to pay a premium to fly the airlines that give them a more pleasant experience. So we think there's a few airlines that are very well positioned to do better than their competitors. Those are Alaska Air. We like a lot. We like Southwest. We like JetBlue. And I don't think that'll be a surprise to most people. Those are the names that people who fly a lot will tell you give you the best experience. We do not like United. We do not like Spirit Air. So I think what we're going to see and what we're expecting to see is more of a separation within the airline industry. So if you're going to play a mean reversion in the airline industry, or if you're going to bet on a comeback of the airline industry, which we think is a pretty good bet right now, I think it's important to pick the right airlines within the sector. What
was the ETF that you have that tracks the consumer satisfaction?
The ticker is ACSI, and it's the American Customer Satisfaction Core Alpha ETF.
And then you're launching
mouthful.
Okay. And you're launching a new one, correct? Or can you talk about that yet?
Yeah, on November 1st, we're launching what we're calling the Reverse Cap Weight ETF. The ticker is RVRS. We're about 3 weeks out from the launch, and what we're doing there is we're using the S&P 500 we're taking the inverse of the market cap weight. So if you take any S&P 500 ETF, right, or the S&P 500 index is market cap weighted, 17% of the index is in the FANG trade right now. And if you take the top weighting right now, is Apple has a higher weighting than the 100 bottom stocks. It's got more Apple than stocks 400 through 500. And what you have is, by rule, you're buying high. Every quarter when the index rebalances, you're buying high, you're very concentrated, and you're tilting the portfolio towards the largest of the large cap. And you're kind of on the wrong side of what, if I'm a French, call the small minus big trade. What we're doing is the opposite. We're tilting the portfolio back towards the smaller companies by using the inverse of the market cap. The smallest of the S&P 500 stocks becomes our top holding. Apple, which is the top weight, becomes our 500th holding. And it really allows the investor.
Phil, we lose you?
Yep, I'm here.
Okay. It allows the investors to, you left me hanging.
It allows the investor to capture, more of that innovation within their large cap bucket.
All right. Phil Bach is the CEO of, and also, what's the ticker for that one? Did you mention that?
RVRS, reverse cap weight.
All right, RVRS. Phil Bach is the CEO of ACSI Funds. Consumer satisfaction is what he's tracking, and apparently now reverse market cap of the S&P 500. Phil, thanks so much for joining us today.
Thank you. Take care.
All right, 8:27 now. Dennis, Joel, what's doing in the markets? Anything in the last 10 minutes that we missed?
Well, I got a surprise for you. The S&P futures just made a new all-time high. We're pushing towards.
Whoa!
Yeah, we're pushing towards the 2540 level. Just out of print at 39.5.
Whoa! Okay, I'm not doing that anymore. S&P futures just keep going up. We know that. Yeah, I used to just say, it just works, man. It seems like every time if you just hold them overnight, they just go up the next day. How many days, Joel, have we, we should go and look at the numbers, but how many days have we, in the last 100 days, have we opened higher the next day?
Oh,
it's got to be 70, I bet you. It feels like it's every day. I'm sure it's not. I'm sure we've had a few down days in there, but even when we got our missile guy, he launches a missile. That one day, we went down the after hours. By the next day, it was up anyways.
Okay, I can't give you, the higher opens, but I can tell you that we are on the crest of a 1, 2, 3, 4, 5, 6, 7 day winning streak. So
it seems like we're always on a winning streak. We get 1 day of losing streak, and then we go on another 7 day winning streak. And I mean, when you put it in perspective, some of these moves haven't been that big, but man, this relentless bull market. In full breakout mode, there's so many stocks, so many internals that are doing great here now too. It's so hard to fight this tape on the short side. BTFD forever.
Yes. All right. Let's talk about Shamu here a little bit. And
okay. You want to get bearish on us here. We can always find a stock that, and actually SeaWorld's going up here today, so we're dog poo-pooing on it. Spencer, give us the details. SEAS. What's going on in Orca land?
I think someone is sniffing around there, trying to get some SeaWorld action. Let me pull up my story here. So, according to Bloomberg, Merlin Entertainment and others have approached SeaWorld about a deal for at least part of the company. So maybe they only want to buy one whale
orcas
or two whales. I don't quite know.
They're letting them keep Shamu, but they want the other whales. They're letting them keep the whale that ate the person.
Oh, that was Telecom, and he died.
Oh, okay. So they got rid of that whale. Anyways, here's a stock.
They didn't get rid of it. He died.
Here's a stock in the biggest perennial downtrend you can ever see, really. You think about this and you look at SeaWorld time. Let's go look here. This was $36 back in 2013. It was 30 in 2014. It was 25 in 2015. It was $20, and obviously lower than that, got down to $11 in 2016. We kissed a new low here again in 2017. I mean, the stock makes new lows every year. It gets a big pop last night on this headline, and I mean a major pop. This got up to 1651 on the news that they might sell part of the company. Come on, people. This is, SeaWorld. This is a dog. Anyways, it got up to 16 bid, And I was like, I got to go get a locate on this. I go out to get the locate. And by the time I got the locate, it was actually already back down below 16 and went so fast. So then I'm looking at a 1550 bid and I'm like, wow, I want to sell it at 16. So, here I am trying to get up there and then just kept going. That's 15 and a quarter. That's 15. That's 14.75. Now it's 14.68. I never did get the short off. And here we are, stock's only up 4.5%. And this is a stock that I don't think anybody's coming to buy. I honestly don't think this is getting taken over.
Dennis mentioned that pre-market high. You did have a high in a $16 handle at 16.11 on August 1st. So that if we do go back into rally mode, that's a level ahead of the pre-market high. Just kind of hanging out here at 1460, 1475. So, someone has a bid there. Whether or not they shorted it yesterday or not, I don't know. Order to fill the gap from yesterday, 1447. So you're not that far away. You're not, really sticking your neck out that far in the gap. Yesterday's close 1411, but there's probably going to be some buyers in here. You talked about the perennial shorts. I mean, it's news. It's reported by a reputable firm. I think yeah. So, I mean, if you're short on this and, you lose money, then you know why. If you're trying to go long based on this, I think there's better places to put your money.
I liked it short at 16 and 16.5 last night. Now that it's given 80% of the gain back at 14.75, it's hard to come in here and say, okay, this isn't good news, because it is good news. So I just didn't think. I thought 16.50 was way overdone. I thought 15.50 was still overdone. It's 14.50 here now, so I don't think it's overdone anymore. That's the issue. But I still hate this company long term. I think SeaWorld is just in a world of hurt. So whether it'd be great for them if they could sell the company, but I don't see it happening.
It's part of the company too, right?
Part of the company.
It's a report. I mean, the price action dictates what happened. We'll see. I mean, kind of similar to Finish Line here. A stock you got some rumors back a little over a week ago, and I've been looking at it, and it's just leaking. I mean, it's just one of those scenarios where, if there's something comes out like this, then, you have to pay attention. But if nothing materializes, the stock is going to go back to trade on its own merits.
Let's go to Imbalance Land and see what we see here. You know what? They're pretty small here today. UNH, this one stands out. $53,000 to sell in that $200 stock, so that is significant here. UNH has not made any trades. It's offered down, obviously, because somebody's reading that imbalance and saying this thing's probably opening down. $200.44 now on the offer there. General Motors, $35,000 to sell. It's come up to a big whole number, $44. I gotta go look at the book. I just feel like there's probably something lurking up there. 44 in the book. Oh, I just can't see it as somebody that's already littered with orders. I saw a little bit earlier, though. I think GM's probably got some size at 44. It's probably got to chew through, but the stock's just been a monster here, so not saying that it can't do that. Ford has some size up at 1250. If you're trading that one, that's where there's been some significant resistance. Didn't quite get up there yesterday, got up to 1246, but it's not coincidental that it's topping out 1243, 1246, because it really thickens up between 1247 and 1250 in the book.
Ford's just not reacting. I mean, it's just, It's not
a pretty good move when you put it in perspective, though. Like, really, we got down Ford, we got to 1050, we're 1250. I mean, that's over a 20% move, really. And the same time that General Motors has moved 35, 44, 9 points. I mean, it's not that much different, really. When it just, it looks better because you're talking, points, and Ford's such a low price stock, but the Ford move's been pretty good. I mean, I'm happy. I'm a lot happier. I still own my Ford shares here. I'm still thinking about selling it, just because of everything that Gene Munster and some other people have been saying that and I don't know if they're going to lead the charge, and even Deutsche Bank saying General Motors is going to lead the charge. Ford isn't really seeming like they're going to lead this charge, so that's why I'm still thinking I might lighten this up. But it's a value stock. I mean, the dividend on Ford is still 4.86%. They're still making money. There's still a lot of Fords on the road, so I'm not that scared in this position. I'm just turning around and selling it tomorrow.
You mean they're not found off-road daily?
Thought it was found off-road dead.
Oh, that's right. Right. We can't say the other.
We're not supposed to say that stuff. We're the Motor City.
Okay. All right. Spencer.
You got to find a good acronym for that.
Spencer, 8:35. What do we got on the docket?
Right. Let's get JC Parets on right now. I'm calling him right now. JC Parets. He's the author of AllStarCharts. I actually saw JC last week out in California at the Benzinga FinTech Summit. Let's see if we can get him on.
We're doing it on the fly, Spencer?
Do it on the fly. Trying to get JC. There we go. JC Parets, AllStarCharts. Got his own subscription service there where he gives his analysis. He's a good technicals guy as well. JC, you with us?
I don't see him there now. Skype is acting up for me, though. Like, my Skype's acting up, too. So, Spencer, we might have to actually take a break and restart this whole call because I now cannot even use my chat, so my Skype chat. So, something's going on.
Joel. All right, Joel, let's take a break, and we'll be...
restart the call.
We'll be right back.
Welcome back, everyone, to Benzinga's Pre-Market Prep. Spencer Israel here with Joel Elconin and Dennis Dick. We're on the line with JC Parets, author of AllStarCharts.
JC, what's doing?
Not much, man. I'm here in beautiful Lake Tahoe at the Riskalyze conference. Got a lot of financial advisors here. Very excited about technical analysis. It's a beautiful thing, guys.
God, you're always traveling, man. Every time we talk to you, you're in a different state. You're in California. You're in New York. You're in Nevada. This
doesn't really count because this is kind of still part of California. In fact, it's my favorite part of California, Lake Tahoe. If you guys haven't been out here, I highly recommend it. And then last week I was at the Benzinga, the FinTech conference in San Francisco. So, you guys are right in my backyard. By the way, that was a hell of a conference. That was so cool. Such amazing companies. Me, I'm a technician, but, I could dork out with the FinTech guys, as much as the best of them. And, that was cool for sure.
Glad you can make it, JC. You just went to Japan, too, and you went to the exchange there. Tell us about that.
I've dedicated this year, really to travel out west, to Asia and speak with different investors. This is my second of 3 trips, right? So I was in Japan in February. I was in Hong Kong, Singapore, Manila, Taipei, Kuala Lumpur. It was amazing. This time I was in Guam and in Japan, and, I was just chatting with investors and, talking about the markets. And, it's amazing. The cultures might be completely different from, what we're accustomed to in New York or California. But as far as the investors' mentality goes, I mean, they make the same mistakes. They're the same things drive their fear and their greed. And, it really just, you read about that and you're told that, but until you actually see how exactly the same people behave on the exact opposite side of the world, regardless of, the cultures, really is amazing. And it really does speak to supply and demand behavior and understanding the way that we think as human beings and, why it is that we make those mistakes. The majority of investors don't recognize that we have those flaws. So recognizing that we have it is step one to recovery, right? And then being able to take advantage of everybody else that, is stubborn and doesn't realize that they're making those mistakes is really the arbitrage that, we try to seek out. And, I'm lucky that investors all over the world, pay for access to my research to, find those isolated situations. And, the beauty of it is that they're all over the place and they're going to keep coming, right? That's the one thing we're guaranteed in public markets, more opportunities. So, patience is a virtue at all times.
JC, there's always a reason behind the charts, right? And when you can interpret that, that gives you even a bigger edge. It's one thing, the chart shows the picture, but there's a reason behind the picture, and psychology does play a big part of that picture. How much of that, when you're looking and doing your technical analysis, are you thinking about the reasons behind the charts, or are you just using the charts?
I am putting myself in I try to always think about what is going to frustrate the majority of participants, right? How are participants positioned? And I get bombarded with sentiment data that I have to aggregate. Jason Gutbert at Sentiment Trader does a great job also, but I try to aggregate all that sentiment, and I try to put myself in the shoes of the buy side and ask myself, okay, is the buy side up on the year? Are they going to just, coast it into the end of the year after Labor Day, or are they going to come in and chasing because they're down? And, my thought process was they're coming in, they're down, and they need to chase. And sure enough, that's exactly what we've seen since Labor Day. Come, the election, everybody was like, oh my God, Donald Trump, the worst person ever. The market's going to crash, go to cash. No, you idiot. That was the time to be pressing longs. That was the time to be getting aggressively bullish. Financials are breaking out. Industrials are breaking out. Technology is coming out of a freaking 16-year base or something ridiculous. Who gives a damn who the hell the president is? Fine, that might be one factor in terms of what the market is doing, but it's a grain of sand in a giant beach. Who cares who the president is? In this respect, obviously. There's a crazy guy in North Korea. Fine. If the crazy guy in North Korea shoots a missile over Japan and the next 2 days gold goes down, guess what, guys? Gold's probably going a hell of a lot lower. And then sure enough, gold just got destroyed throughout the month of September. So, it's sentiment for sure and positioning, right? It's the combination of sentiment and positioning, call it the same thing, whatever it is. But those unwinds, that, when you ask why it is that they're doing, it's not a company's fundamentals or their earnings or some new drug. It's how investors are positioned to take advantage of that information or future information. And when they're positioned in the wrong way, the unwinds can be spectacular, right? And we're witnessing that now. You have people talking about the Russell 2000 this huge base, this huge top, and how the market's going to crash. And now we just broke out. So where's that narrative now? Now you have small caps, mid caps, micro caps, all breaking out of 10-year basis. You have these people talking about how the market is frothy and how the stocks have gone too far, too fast, or whatever bullshit they're making up today. How could that possibly be the case if small caps, one of the most important indexes on earth, went absolutely nowhere for 10 months, nowhere, and just broke out in the last couple of weeks? This is not something that we're at frothy levels. This just happened. We are just now breaking out. So all summer, I've been in the camp. It's not that I think stocks go a little bit higher. I think stocks go a lot higher, and I still think that. I still think we're going a lot higher. I think that the street is positioned in the wrong way. That's still the case, and I think we're going a lot higher. I think we need to be buying stocks. I think they're not gold, not bonds, stocks. Good old American stocks. Keep it simple, stupid.
JC, make America's stock markets great again here, and they are already great, and they're even getting greater. What about the oil market? Because we've come back a little bit here on oil. This one's a harder one to read. We pulled back a little bit here recently here. How are you reading the oil chart?
You guys know me. I look through thousands of charts a week. I mean, I look through more charts in 1 week than 99.9% of humans look through in a lifetime, right? You look at a million U.S. stock charts, they all look great. New 52-week highs, huge bases everywhere, breaking out, huge bases. Old uptrends like in tech and healthcare and stuff like that, still in place, right? Beautiful charts all over America. And then you look at oil, and it's just not that, right? If you're gonna buy something and you have all these beautiful charts, and then you look at oil, it's like, it's like such a disappointment. It's like, you got the bases you got the bases loaded, one out, you need some runs, and now you got the 8-hitter up, the second baseman, who's good for an occasional bunt. You know what I mean? It's like, oh, what a disappointment. So listen, I think the path of least resistance is higher. I think we probably see $60, 62. Right now it's still a sideways mess. I'm not that nimble, but if you are, I would use that 55 level as the key level and be long only if we're above 55 and take profits above 62. To me, that's a little bit too, that's not going to work for me. So that's kind of how I would look at it, 55 to 62.
JC Parets on the line with us, fired up today. And I know you've been this is just not a new stance that you're taking. I follow you on Twitter, and this is all the stuff you've been espousing on Twitter. What I want to ask you, and you're pretty good at this, targets, Fibonacci extensions. JC, let's look at the S&P 500 or whatever index you prefer. Where are those Fibonacci extensions taking us to?
Yeah, I think we see 2,600 for sure in the S&P 500. That's the big level that I'm watching. 2,400 has been really the support. That's been the line in the sand where it's been like, listen, if we're below 2,400 in S&Ps, then something's probably wrong, and it's probably going to be messy, right? That's been kind of like the key level since the summer. After we exceeded it, of course, that was the original target. So now I would just continue to use that to the downside. Obviously, we're well above that. So from a risk-reward standpoint, to buy S&P 500 right now with a target of 2,600 is clearly not as favorable as something, in the summer when we're closer to 2,400, of course, when, the whole idea was to buy weakness into 2,400, right? So I think we go to 2,600. I think that's definitely where we're going in the S&P, and I think we see 26,000 in the Dow Jones Industrial Average. And the same level to the downside is 21,000. We're above 21,000. We need to continue to be long Dow Jones Industrial Average. We're obviously well above that, but that's the level. It is what it is. And I think 25,000. I think that's where we're going. You look at all of these charts one after the other, and I think that the common denominator is how much upside room there still is left. You look at something like microcaps, right? Russell microcaps. I think we see $100 in the IWC. That's still a long ways to go. And if the Russell microcaps are going all the way to 100, then it's probably not happening in an environment where stocks are getting crushed, right? You look at the most important, maybe the most important stock in the world, arguably, JP Morgan, and, we're now breaking out again. If we're above $95 in JP Morgan, we need to be long. And I think we can go as high as 130. JP Morgan's rallying that hard. Banks are probably doing well. I think that financials go back and retest those 2007 highs. Look at the XLF, right? That's the Financials Exchange Traded Fund. And I think we're going back to the 2007 highs. And if financials are going up that much more, I just don't see an environment where stocks are getting clobbered. If JP Morgan is doing that, XLF is still a long way to go. S&P goes to 2,600. Dow Industrials go to 25,000. These are targets that are not a little bit higher. These are targets that are a lot higher. So I think there's a lot more room to run, and I don't think that the street is positioned accordingly.
JC, there's just so much rotation. It always seems like money's not rotating out of stocks. It's just rotating into different stocks. It's like there's no fear out there, so they're not coming out of the stocks altogether. I mean, financials were laggards for a long time, and now they're the leaders, where you're seeing stocks, like your Amazons, maybe have a cooling period here. I mean, it just looks like healthy rotation to me as well.
Yeah, that's the thing. You look at individual equities, and what is the weakening? Where's the weakness? Right? We don't have any weakness. There has to be a sector that's going to drive the market lower, and we just simply don't have that. We have sectors driving the market higher. So we had technology that's been the leader. We had industrials that has of course been the leader. Financials were lagging for sure. And now they're breaking out of 8-month bases. So if financials are breaking out of 8-month bases, you talk about the market being frothy. The market is not frothy. We are just now breaking out in banks. You said it. Underperformance for 7 months. And now we're breaking out. So I think that we're 100% going higher.
JC Parets is the author of AllStarCharts. JC, thanks for joining us today. And he's gone. All right. That was JC Parets, everyone.
He's a busy guy.
He's fired up.
Oh, yeah, JC's always
great. Fired up.
And he calls it how it is. He calls a spade a spade. He's not scared, come out here and just give his honest opinion, and what's happening. That's what I like best about him.
JC wants to come back. Should we come back? All right.
He's got something else to say.
He's got some more to say. He's got some more to say. JC, he's got some more.
Sorry, guys.
It's okay. He's fired up. JC, where were you going with that?
Well, my point is that, the question was regarding the rotation and how it doesn't allow the market to fall because another sector kind of comes in and picks up the slack. And that is the beauty of a bull market. That's what a bull market is supposed to do, right? So if we had sectors breaking down, like, for example, energy, right? It was a disaster. But now it's coming back, right? So it's no longer crashing. So you have all of that market capitalization getting slaughtered, going down, making new lows. But there weren't any other sectors participating to the downside. To the contrary, you had financials consolidating, right? Like you guys mentioned. You had other sectors like industrials and technology breaking out, right? So the fact that there was no follow through from anyone else, in fact, to the contrary, was evidence that was just a one-off, right? That was just one sector underperforming while the rest, continued to do well. And now energy's back. So if you're a bear, if you're a stock market bear, and you are one of these gloom and doomers that think this market's going to crash, ask yourself, what is the sector that's going to lead us lower? What is the sector that's currently breaking down that's going to drag everybody else and then, lead to a bigger disaster? I can't answer that. We don't have that. We have the exact opposite. We have financials just breaking out again. We have small caps breaking out. Materials are up 9 months in a row. Industrials continuing to make new highs. Healthcare looks great. Even freaking biotech. You know what I mean? So again, just that healthy rotation underneath the surface, sector by sector, one at a time breaking out. Those are characteristics of uptrends. Those are characteristics of bull markets, not characteristics of markets that are about to crash. I was asked on Twitter yesterday, JC, if this was July of 2007, how would we know that buying the stock market was not a good investment? And there was a lot of things. Financials were literally crashing relative to the S&P 500. You had big tops everywhere. Right now, you have big bases everywhere. So this is not that environment. It's the opposite, really.
All right. JC Parets, author of AllStarCharts. JC, thanks so much for hopping on today.
Yeah, no problem. Thanks for having me, guys. Sorry about the phone mix-up. In Tahoe here, the
Tahoe.
reception and everything.
Don't I know it? Don't I know it? Tahoe. Things are crazy out there. All right. See you, JC.
You're not supposed to be on the phone in paradise here.
All right.
You're supposed to be enjoying.
Get off the phone and all right. Have a good one. 8:55 now, guys. Anything in imbalance land we want to get to?
Well, I'd like to get to the ratings because there's some big ones here this morning, and we haven't mentioned them yet. First of all, I want to go to Morgan Stanley. They have a pair trade going on here. They are upgrading Biogen. They are downgrading Celgene. So upgrading Biogen to an overweight, putting a price target of 375. Downgrading Celgene to underweight and putting a price target of 120. I don't know how to feel about this because I own both stocks. So on one hand, I'm making 5 points because my Biogen, or I'm making 4 points because my Biogen's up 4. But on the other hand, I'm down 4 points because my Celgene's down 4. So I guess I'm indifferent, although Celgene's down more on a percentage basis there. Thoughts here, Joel, technically speaking? I mean, Celgene's at all-time highs here. Biogen is a ways from all-time highs. Maybe they're looking at that. Maybe they're looking at valuation. I didn't read the note, but thoughts on the technical?
I'll just give you, Biogen is $4 off that pre-market high of 323. So we can keep that as a target above that level. Keep an eye out for 326. You had a pair of highs there in September 14th and 15th. Coming back on the downside, you know me, I'd be looking for a gap fill if someone was shorting this, and that only would take you to 316.55 because that was yesterday's high. Celgene, I mean, you're at all-time highs. What's your target? We were at all-time highs. What's your target? Where's your stop loss in it? 142.5. Man, you broke out from there and you had a lot of congestion at that area, and you're just below it now. So 142 level of control in Celgene.
Stock that may challenge an all-time high here today. Microsoft is about 50 cents away from it now. It is up significantly because Canaccord is upgrading the stock this morning. Microsoft up 72 cents here in the pre-market. Within striking distance, that all-time high up there at 75.97. I got to think, if we get up towards that level, there's going to be some sellers just because big whole number. That's where we got to before. $1.30 is probably what a Canaccord, is on the high side on Microsoft is worth. I'm thinking there's going to run to some resistance up at 76.
Yeah, especially since the last time that you jotted up there, you went to 75.97 on September 18th. It really weakened to close the day at 75.16. So second time up to that level, I think you might see a little bit more resistance ahead of it. Also, if you're looking to get out at that all-time closing high, folks, that was made on September 19th at 75.44, and that's currently where we're trading. 78 cents is a big move in the pre-market for Microsoft on only 65,000 shares.
Western Digital, WDC, trading down $1.40. Deutsche Bank downgrading the stocks. You still got this one, Joel.
Yeah,
you still holding?
Yeah, they're shaking me. They're shaking me.
They're starting to shake you a little. Like, give me your stock. Yeah. Give me your stock is what they're doing.
Yeah, but I'm going to stick with the downside on this one. Couple downgrades. Just seem like with the way all the other tech has been running, and this has kind of been going the opposite way. So I'm not sure if I'm going to swap it out for the Seagate or not. But 82.32, I believe that was, let me pull this up real quick. It was down on 14,000 shares. Western Digital, I think 82.32 was your 2-day low. So I'm still going to stick with 80 mental stop, breaking through a triple bottom if you do pierce that 82.32 low.
Jumping over here to Coach. They are getting downgraded at Piper this morning, COH. I haven't looked at this chart in a while, but it's not pretty. I mean, if you want to find one sector, that is not pretty. And, JC was saying what sector is it going to be. I don't know if retail can bring down the whole sector, but I'll tell you, the retail stocks still don't look good. This Coach chart does not look great to me. Obviously, Macy's just can't pick its head out of the gutter here. Even Amazon has started rolling over. Retail is looking weak here. And it's seasonality. Retail is actually supposed to be starting to get stronger as we start getting closer to that, Black Friday Thanksgiving. I mean, we're still 6 weeks away from here. My buddy Jamie Upright was saying actually seasonality, the way they teach it, Upright trading starts after first day after Labor Day. So, we are in that period where retailers are supposed to outperform from a seasonality perspective. That has not been the case yet, though. Coach chart does not look good to me either.
Bearing down at that $39 level, only 32 cents away from that, trading down 40 cents in the pre-market. I mean, you could see 39 is held up here since May, one low under that. Not a good looking chart. I'm sure if you get back anywhere near unchanged, because you kind of did close near the high of the day yesterday, you had a close at 972 with a 998 high. We're still above yesterday's low for the most part, but 39, major area of support here in Coach.
There was some commentary here on Snap, and Snap is trading down. In full disclosure, I am short Snap here just as a short-term trade. Pretty much from this commentary here, estimates were cut at Needham here this morning. There's no ratings change. They were already bearish on the stock, but they were saying you could see 10 to 20% lower is what they were saying. So kind of reiterating their point here. So it's not like it's a new note, but it's a bearish note, that being said. And I think that's why Snap is trading down a little bit here in the pre-market. Technicals on this one.
Man, there's a bunch of lows here, and we were trying to dissect this one on the pre-market show. I mean, you got a series of lows right here at 1430, 1440. So important to just holding above there under 1430, Dennis. I think you get a shot to bring it in at $14. Your 5-day low, 1397.
Dennis, any notable imbalances today?
Yeah, we'll go quick because we're 9:01. I know we're going over. UNH still 58,000 to sell. That is significant. Twitter 57,000 to buy. So we haven't talked about Twitter for a little bit. Manitowoc MTW. This one's interesting. This was Karen Feinerman pumping it on CNBC last night. We were talking about Andrew Leftwell. She's got some pull there too. This trade up 4.5% because this was Karen Feinerman's pick of a stock. That's I think she said she thought it could double. And the stock is obviously trading up 41 cents on her opinion there. You know how I feel about opinions. But anyways, MTW is up on it. So 109,000 to buy this morning, and MTW is obviously quite a few people. Watch that segment, and they're coming in here to buy it this morning. If that opens up too much, I might be a fader on that one.
All right, that is our show for the day, folks. Looking ahead to tomorrow, we've got Tommy Lackey joining the show. Tommy hasn't been on with us for quite a while. Took a little bit of a break, but we're going to get Tommy on the show tomorrow, so very, very excited for that. As far as today's show, you can catch the whole thing again on iTunes, SoundCloud, or Stitcher, or by going to youtube.com/Benzinga TV to watch the show with the charts as it aired live from 8 to 9 every day. Don't forget to like us on Facebook at PreMarket Prep on Facebook as well, and you can check out Joel's midday update videos there. So that's it for us. Have a good day, folks. Go look out there. We'll be back with you on Friday.